Hello and welcome into the KE Report. Shad and Corey here as your host, and we're talking today with Erik Wetterling, also known as the Hedgeless Horseman. And we'll put a link to the Hedgeless Horseman down below so you can follow along with Erik's work. And Erik, we were talking off mic about the value proposition that you're seeing in the second wave of the Lassonde curve. And this is really where a development stage company is kind of getting out of the orphan phase, or the valley of death, as Lassonde calls it, and starting to move towards a construction decision, where in that next year or two, most companies see at least a doubling in share price after studies have been done on literally hundreds of companies. So you have this second wave in the Lassonde curve where there's a value creation event. And sometimes there's takeovers, sometimes there's some surprises, but you're looking at development stage companies that have economic studies that show just how profitable they would be at much lower prices, but in consideration of the higher gold price, you see an acceleration phase for the development stage companies. So why don't you walk us through what you're looking at?
Yeah, I mean, I never really used to care much about the second part of the Lassonde curve. That was kind of too boring for me personally, for better or for worse. I mean, people probably could make quite a bit of money doing that. It simply hasn't been my cup of tea. But today, there's never been higher ASIC margins for the gold miners. I mean, even tier 2, tier 3 mine might have 1,500 to 2,000 ASIC margin if it was in production today. And of course, in the junior space, we still have that depressed junior retail sector sentiment. So it's like you're still buying ounces like we're not in a hot sector. But the gap between what you can buy ounces in the ground and the profit margin of ounces coming out of the ground has never been higher. And in absolute terms, the profit margins on gold coming out of the ground has never been higher. So it's like all of a sudden, I didn't plan for this because I don't try to predict too much. But okay, now I find myself in a situation where we have record high gold mining margins, and even the advanced ones are selling like they're never going to get into production, or the margins are going to collapse. And I just remind myself of some quotes or thoughts by Jonathan Goodman, who said to him the most important thing is how fast new mines repay their capital cost. And again, today, I don't know what's going to happen in the future, but right now, these gold projects, any gold project would have the quickest payback period they've ever had in history, perhaps, or at least in the last 40 years, I would think. Every project looks on paper really good. And then he went on to say most mines start off with a 10-year mine life, and you wake up 10 years later, they still have a mine life for 10 years. And he follows that with long life mines are NPV irrelevant. If you can buy them for a quarter of NPV, you're really buying it for 5 or 10 cents on the dollar what they're worth. You don't need a lot of those to be very successful in this business. So wrapping that up, basically, it's like, okay, payback periods for whatever gold project has never been higher. And it's only going to be really relevant, of course, for a project that can get into production. And as per his words, I mean, hey, if you're buying it for whatever, quarter of the MPV, and it's actually, one of those mines that's going to be producing for more than 10 years. I mean, there's a lot of examples of that. So like, how cheap are some of these advanced juniors that could actually get into production before, let's say, gold has too much time to collapse or inflation to go up enough, whatever. It's like I'm seeing some juniors there, turning about and kind of, we're pushing to, potential development phase, because I think it makes total sense. I mean, the arbitrage would be simply huge. I mean, if you can buy ounces in the ground, and if when they come out of the ground, if the picture in the future is somewhat similar than it is today, I mean, that's 2,000 ASIC margin per ounce.
Hey, Erik, there's no denying the fact that where margins are right now, the highest ever, yes, payback periods are the lowest. I think one of the biggest issues that we have is that this second part of the Lassonde curve, these so-called development stage companies, ones with defined resources, this is a pretty saturated part of the market. We've seen companies over the last 10 years continue to build up resources, and now a lot of companies have resources. So we were joking 10 years ago, 1 million ounces was the holy grail. Now, if you don't have 1 million ounces, you hardly even have a resource. So when you're, I guess, analyzing some of these companies, what do you look for? Is it their production profile, how many ounces per year they're going to produce, what CapEx that'll cost, because money still seems to be hard to build these things? Is it jurisdiction? And even what economic assessment will you go down to? A PEA, that project is still years, maybe even a decade away from being built. So what is your pecking order of what you're analyzing when you're looking at these development companies?
Pretty much all of that. I mean, there's going to be no cases exactly the same. I do think that, for example, if you have, a low capex, high margin project that could survive at quite a bit lower metals prices, I mean, I think it's relatively easy to be free rolling in that situation. And Goodman also mentioned that when he's talking about porphyry deposit, if they don't have a high grade starter pit, he's not really interested. So for sure, I think, I mean, you could call it high grading, whatever, but if you have a project that's either low capex or it's, let's say, have a very high grade zone or something. I mean, even if gold fell $500, maybe the payback period would be 1.5 years or maybe up to 2 years, I guess. And you would still, I mean, if things go kind of well, and if it's not a shitty project, yes, if gold retraces in 3 years, 4 years, 5 years, or whatever after it's in production, you won't make as much money as if the margins were staying at these levels. Then you would be making a shit ton of money because you would, again, be paying back your investment basically every year. So I guess, like always, there's no guarantees, but it's like I'm just coming down to the fact that the spread between what ounces in the ground are sold at and what value you get from taking those ounces out of the ground has never been higher. So obviously, I mean, we don't know what gold is going to be at in a year from now, let alone 2 years, 3 years down the road. Same with inflation. So, I mean, I would be thinking that the most interesting ones are the ones closest in time. And of course, then you have some situation where it's like, okay, something can be in production relatively quickly. Yeah, you might pay up for that because, okay, there's less time for gold to retrace 50%, let's say. Whereas, like, okay, there's still projects that might be, let's say, 3-4 years out, but they're still selling like, I don't know what. I mean, that they're never going to get into production. So it's always a balance of risk versus reward. Because I think there are projects out there that look very cheap, even if gold was like $500 to $1,000 lower. So then you simply have a very high margin of safety, as I would see it.
Well, Erik, we do see a lot of companies that are trading for a lot less than just a quarter of their NPV. There's companies trading for a tenth of their NPV, and these are on PFS or FS study companies. So companies that are more de-risked, the studies are more advanced, the timeline to a construction decision is closer. So would those have more attention to you than, let's say, a company with a PEA that looks promising, but to Corey's point, is still much further away? Would you be isolating the companies that are already at PFS or FS studies?
I mean, they would be more of a threat in a sense, but then the problem is like, okay, can they actually finance it? Can they build it? Because it can be more advanced in from a study perspective, whatever. But if they can't raise the money, then it doesn't really matter. Then the PA project might catch up because they have, let's say, even lower capex project, even a quicker payback time or something, and simply looks more attractive for different reasons that would, get them to get a bank loan or somebody to actually fund it. So I think it's, as always, it's a balance because let's face it again, yes, now the margins are record high and even the shittiest of projects basically looks like a gold mine at today's gold price. But I mean, I'm not betting that things would stay exactly the same. Preferably, I would want to get the best of both worlds, where it's like it is a legit project. It's selling for less than what the NPV is at $2,000 gold or $2,500 gold, and it's selling for a tenth of what it is at $3,000 gold, for example. I mean, that gives me a lot of room to be wrong and for things to go wrong, because the few cases that work out, I mean, and who knows, maybe gold goes even higher. Like, I have no idea. But I mean, you want that upside to pay for potential mistakes and all that. But I would say that, yes, the more advanced in a sense, I guess, the better. But hey, there's been projects with feasibility studies out there that are not really good projects for whatever reason, and they've been in feasibility stage maybe, or PFS stage at least, for I don't know, decades or something. So it's always an art, and that is, I guess, the hard part about investing in this space, that there's no, silver bullet, let's say. But I would just, try to find the ones that are, I mean, preferably very advanced and low difficulty from a technical perspective, either financing and or the ore body is not that difficult. And of course, I mean, if it's very remote or whatever, it can be a feasibility study, but it's not going to be a mine in 10 years. Then it's not as exciting, because nobody knows what the gold price is going to be in 10 years. But in 1 year, I'm guessing it's going to be, I don't know, 20% higher or lower from here or whatever.
Well, a lot of these advanced assets, even when they are advanced, still take a couple years to build. Even when a new company comes in, they do redo a lot of work, and they need to draw up their own plans. But then, Erik, that brings up the whole question here is, it makes sense math-wise, economics-wise, for companies that have cash to move in and buy these assets, right? And then start building them. But the question is, why aren't we seeing this? The majors continue to divest capital. Mid-tiers, they've been buying some projects, but not many. What do you think the holdup is here? Why aren't we seeing more M&A and more companies that know how to build assets taking on more assets?
Yeah, it is a very, intriguing picture. We've seen Agnico, they seem to be still on, quite aggressive, making placements here and there, funding juniors, and at the same time Newmont sold, I think, 7 or 9 mines or something, and they're only going for tier 1 deposit, I guess, to keep. And I don't know if that's a manpower issue, because we've heard many people say that it's like the problem for this space is there's not a lot of or not enough competence, let's say, around. So I mean, if you have a few really good mining teams and you have 15 assets, maybe kind of makes sense to sell some of those and focus on getting projects big enough, and you have your A team involved. And then we see Barrick Gold changing its name to removing the gold in the name and appear to be betting on copper. And at the same time, you see, I think his name is John Paulson, a billionaire who's buying 50% of Donlin Creek from Barrick. So it's like, why is he buying that? Obviously, he thinks that gold in the ground is extremely cheap. So it's like, who is the smart money? Is it the majors who seem to be kind of, like deer in the headlights, except for, I guess, Agnico? Or is it, John Paulson, for example, a self-made billionaire? So it's like, to me, I don't get it. But it's like, if I had $1 billion right now, I would probably buy a few advanced gold projects with 50% premiums if I was able to do that, and that had projects good enough that I could be wrong about the current margin staying here. If they're cheap at much lower gold prices, then it's also kind of a free upside. And if these gold prices hang in there, I'm just going to make a boatload of money, and I wouldn't even need every mine to work out.
Yeah, it is interesting the different strategies being deployed right now, because in Paulson's words, he's looking to get that NovaGold project, well, NovaGold owns half of that project, into production imminently. Like, they want to move that Donlin Creek gold project into production and capitalize on these high prices. Other companies are saying, hey, I'd rather bet on the longer term of copper. But there's still a lot of companies that could take a project and partner with a junior, and together a mid-tier and a junior could pull it off. When you think about strategic positions, you brought up Agnico, but we've seen a lot of mid-tiers and a lot of even majors taking strategic positions in advanced stage companies. So not just the early stage explorers, but in these advanced companies. Do you want to see some of those christen the deal with, hey, let's even take a bigger stake from the company instead of 9.9 or 19? Maybe they take a 50-50 JV and put it in production. Would you be open to that? Or are you hoping some of these junior teams try to raise the capital on their own and put it into production, even if that's not their skill set? What's your end game for what you want to see happen here? And then, how would you know that the project you've invested in or the company you've invested in is on that right track?
Yeah, that's, as always, very hard to say. And I don't have a firm answer on that. I'm not a mining engineer either. I know there's talk about, let's say, some juniors where they're, quite advanced and can't really figure out like why are they selling so cheap, and then you hear somebody say, well, the market doesn't believe they have a team that can build that project. So in that case, it's like, yeah, from one perspective, it is an advanced project that could get into production much quicker than most projects, but in the eyes of the market, they don't have a team that could actually do it. So that's always hard if you don't know everybody in the industry, I was going to say. So then it comes down to a kind of a risk reward situation. Okay, if you give away 50% of the project to a major, whatever, it's like, yeah, could you be leaving some upside there? I guess so. But at the same time, you're getting that back because it's a low risk project. So maybe that's actually a pretty okay deal. So it's like, okay, lower chance of getting whatever, a 10 bagger over the next 3-4 years, but the odds of getting a 5 bagger goes up a lot, and the probability that we will go into production successfully again goes up a lot. But you give away some of the upside. So I think it's always a balancing act, really. And that's also why it's, if you have a junior with a major gold miner in it, especially if they have some recent vote of confidence, let's say, that takes care of a lot of due diligence. I mean, the miners are not dumb. I mean, they're not looking at, what could this trade for in the market? They're looking at, can this actually be a mine? Can this be a mine that works? And given that I think, especially the majors are so scared about making mistakes. So I don't know if that's the same for the mid tiers, but I assume they're looking at scenarios where it's like, okay, margins go a lot lower than they are now, perhaps, because nobody wants to be, Kinross in 2011 buying Redback Mining for 9.2 billion. So I think they're also much more conservative. So maybe their vote of confidence means even more today. So again, it's like, I'm not smarter than whoever the mid tier is that invests in some advanced juniors. So that goes a long way for me personally.
It's just interesting to me to see the lack of mines being built or pushed forward or accelerated at that sense. We're not seeing that in the market. These companies, both large and mid tiers, are taking their time, it seems like. Even some of these development companies that have brought together a couple projects that are development stage projects, still feels like news is slow. Maybe that's permitting problems, maybe that's financing problems, but this sector, with the margins we are seeing, we're not seeing mines come online, and we're still seeing companies fail at bringing mines online, especially the small scale mines where they say we're going to bring it on first at this small scale level and fund what we need to fund moving forward from production. It still doesn't seem that easy. Crazy, really, when you think about the margins that we're seeing. So, Erik, what about individual companies, individual projects? Which ones stand out to you? If you're doing more research in this area, care to share any of the projects that you think, I guess, are takeout targets? That's really what it's focused on here, is who's going to take these over, who's going to build them. What's on your radar?
Well, I'm actually not looking too much on takeout targets, because the way I look at it is, if they make it work in a sense, it's either going to work and you're going to make money by owning the company still, or in that case, if it does work, yeah, it's a higher probability that someone will take it out, or at least it's like if you start the development phase, let's say, that's going to light a fire under an acquirer. And I mean, we've seen that quite a few times where it's like, I think it was, Arizona Mining, for example, it's like, okay, they de-risked it. I think they even started construction, and then South 32 came in and swooped it up. So it's like, that's something I can see absolutely happening. I mean, there's some, obvious favorites, which I've talked about before, like Integra, who basically has a cash flowing mine already, and it's already, I think, throwing off, 4 times the margins that they were expecting when they actually acquired the asset. And they have 2 development assets behind us, like De La Mora. I don't know, it might not be too long before that's in production. And of course, if the PFS is somewhat accurate, AISC of around $1,000, and if Florida Canyon enjoys these kind of margins, like 1-2 years more of this kind of cash flow, maybe they can self-fund that, where De La Mora could survive at much lower metal prices as well. Of course, it might be making times hard for Florida Canyon if gold goes down to $2,000. So that's a risk in that case. Then there's Cabral Gold, for example. They're pushing towards low capex oxide saprolite production. And what benefit can come out of that? Well, they could become kind of a self-funded explorer / developer from that. I'm also looking at like Amex Exploration, who has a very high grade zone. So, I mean, how many years worth of high grade production from that mine or that deposit would you need for the project to pay itself back? And who knows, that might be one of those low gold stories where it's like, okay, you start off with 1 million ounces or whatever, and 2-3 decades from now, it's going to still be producing. And at the end of the day, it's going to be producing 3-4 million ounces plus. I don't know, but it's like, I like those kind of stories where it's like a lot of margin of safety. I don't necessarily love the huge capex, low grade, somewhat low margin projects where it's like, okay, if gold prices retract, the payback period is all of a sudden 4 years instead of 1 year or something like that, and it can't actually survive a downturn. I like the ones where you have some margin of safety.
Well, Eric, just building on that point, what about the companies? You mentioned that some of them have gotten taken over as they started a construction decision, and we actually have seen that. Think about Marathon Gold trying to build the Valentine Gold project, and then Calibre taking them over. And then before they've even got it finished and built, Equinox is taking Calibre over. So we've had an even bigger fish eating a bigger fish. We've seen the same kind of thing where certain companies are getting to that point where they have their capex raised now. Are they takeover targets? I would think of companies like Skeena that's raised their capital stack. They're trying to build the mine, but they haven't got it built and producing yet. Or we just saw Troilus raise a lot of the money that they need to be able to get their capex in place. They're working out the final details on a royalty or stream, but they're almost there. And that's 11 million ounces of gold. It's a tier 1 deposit. Are some of these companies like Skeena or Troilus now the takeover targets because they're getting closer and closer to the build?
Yeah, I mean, I guess so. I mean, it would make sense depending on, of course, the expectations of the major, but that's the threat, right? I mean, let's say you have a feasibility study and we know what the gold price is. So it's like, okay, what if this works according to the feasibility study and they're going to have I don't know what the margins are expected to be for any specific project, but let's say $2,000 ASIC margin. And you're buying it for $500 an ounce or something right now. And you expect that's like, okay, if we acquire this, the capex is already done anyway, so we don't have to pay to build it actually. But it's like, okay, what's the payback on our acquisition? Let's say, if gold prices stay around these levels, it could be, I don't know, 2-3 years maybe for these large companies. Again, I don't know the specific market caps of those companies right now. So I guess it comes down to a risk reward situation for them as well. It's like, can this survive at much lower prices? Can this be producing for 20 years or something? Because of course, as retail, we're thinking like, we want, a 10 bag or whatever. I mean, the major miners, they also don't want to make big mistakes, I think, and survive the downturn. But as you get closer to, the rubber hitting the road, the production is starting. It's like, if you didn't buy a developer at whatever it might be, $300 an ounce or something, and it's like, 6 months from now they're going to be starting production. All of a sudden, if it works, they're going to have $2,000 an ounce of ASIC margin. I think we can forget to be buying it for $400 an ounce or something. So it really it wouldn't be a surprise, man. Of course, it comes down to, some cases might be overvalued. It's like, the market knows they're going to be good. The majors think it's a good project, but there's not enough margin of safety for them to come up with a premium that makes sense for them. Or, there can be a bunch of different reasons, I assume, for a major. And then it comes down to, it's like, okay, what's priced in, what's not priced in? How do the majors look at risk? How robust do they think the project is, etc.? So that's always a gamble. And I personally, I want, as always, I want pretty big margin of safety. It's a no-brainer where it's like, okay, even if, 1 out of 4 of these work out, I'm going to be making money. I don't want to be sitting there. It's like, I think I can see some 30% upside or something. Then I can't really afford to be wrong.
Yeah, there's just a lot of different ways to play the sector, and there's different stages of companies. There's still a lot of advantages to being in the drill plays and the earlier stage discovery stories. There's a lot of advantages to being in producers that are already capitalizing on the higher metals price. But this sector in the middle, these development stage companies, there's even a lot of different shades of gray as far as these different companies here and where they're at, how advanced they are. And it does play into the type of deposit is, the mining method. It means different teams have different skill sets that could come in and partner with those companies. It's going to be an interesting space to watch how these development stage companies either make a construction decision, get it into production on their own. Do they partner up with a larger company to take it in production, or do they get taken over? So definitely some ideas to do some more research on, and for people listening in to look through their portfolio or look through the companies on their watch list and see which ones may meet this criteria. So definitely something we'll keep following along with here at the KE Report. And if those listening in want to follow along with Erik's work, click on the link down in the show notes. It takes you over to the Hedgeless Horseman website, where you can follow along with the companies on Erik's radar and some of the deep dives he does into those through written and also video format. So Erik, always great having you on the show, giving us some good food for thought to kick off this week. And as always, looking forward to our next conversation.
Thank you, guys. And as always, consider me biased. I might own shares in the companies I mentioned, and some might be banner sponsors as well.